Good afternoon. Welcome to today's webinar. I'm Chris Mortara with AdvisorAssist, and today we're going to discuss the SEC's 2020 priorities as it relates to their OC examinations. The overview of today is that we're going to take a look at the importance of compliance, the role of compliance at a firm, as well as, before looking at the exact 2020 priorities, taking a quick look back at what we saw as far as SEC enforcement actions and some items back in 2019. Just a quick housekeeping note, I just ask that you enter any questions that you may have through the chat box located in the Zoom application. And as we wrap up the content here today, I'll go ahead and answer those questions at that time. So you can ask as many questions as you want throughout the course of the presentation. So as you can imagine, the SEC has conducted a ton of exams, thousands of exams over the years, and they've identified a number of hallmark items that they felt important to point out during this year's priority communication. The first certainly being a hallmark of an effective compliance is a commitment from senior executives to set the tone that compliance is an integral part of the organization's success. They also noted that compliance is active engagement in most facets of firm operations, as well as early involvement in important business developments, such as product innovation and new services, is also a key hallmark to a strong compliance program. And lastly, the communication regarding empowering CCOs with full responsibility, authority, and the resources to develop and enforce policies and procedures as it relates to compliance at the firm. So as we take a look back to 2019 in terms of not just the SEC examination process and some of the things that were identified, but also some of the items that will be pushed forward here in 2020 in terms of obligations of SEC registrants. So certainly, we're all aware that the SEC continues to focus on which mutual fund share classes are being utilized by advisors. In particular, we're looking at cases where if an advisor uses a share class that is more expensive than another share class available through the firm, why is that taking place? Now, there are certainly reasons or explanation as to why a share might be on your books. Could be it was recently transferred in, could be subject to a CVSC, it could be a significant tax unrealized gain built into it, and there's no alternative to, for example, convert the A share into a lower cost share class. In terms of 2019, we identified or noticed that the SEC, after completing the self-reporting period for RIAs, ended up enforcing cases on an additional 16 RIAs where share class selection was an issue, and they collected over $10 million in fines due to affected investors. So rest assured that as we move into 2020 and beyond, as part of your examinations, the SEC will certainly be looking at your holdings, and if you do have share classes that aren't necessarily the lowest share class on your books, that you review these periodically to make sure that you have documented reasons as to why you're holding these positions, and hopefully that you have an exit strategy with respect to diluting yourselves of these higher cost share classes. We saw in 2019 that the SEC had their first enforcement cases as it related to electronic investment advice, talking about robo-advisors here, as well as the continued scrutiny of private funds in terms of things like disclosures as well as conflicts of interest. Additionally, the SEC also continued to focus on digital assets, as we saw the first no action letter in 2019 as it relates to digital assets. Transitioning into the 2020 priorities, a lot of the same themes are seen here in the 2020 priorities that we saw last year and we've seen over the last several years. One of the key focus areas, and it's in a number of different points within the priorities, has to do with disclosure and adequate disclosure. Last summer, the SEC adopted new rules as well as forms and amendments, specifically last June, and those also speak to this priority and why it's so important that firms address and have accounted for proper disclosure as it relates to their business and practices. When it comes to conflicts of interest, it's critical that firms are reviewing as well as disclosing any conflicts of interest arising from fees and compensation. Areas where the SEC has spent time focusing on within this area include revenue sharing arrangements with issuers and service providers, as well as direct or indirect compensation to advisory personnel for executing client transactions. When we look at sales practices, it should go without saying, but the SEC is always going to focus on higher risk products. And why is that? It has to do with the complexity of the product, potentially some lack of transparency. Usually there are higher fees and expenses built into these types of investment vehicles. What types of vehicles in particular do the SEC focus on? They certainly have spent or focused on private placements, leveraged ETFs, and although not necessarily as complex as those products, they continue to look at mutual funds and traditional ETFs based on their widespread usage amongst RIAs in our industry. And an additional area of concern that the SEC pointed out when it came to mutual funds is if there are any incentives in place that influence the RIA with the selection of any particular mutual fund share classes and the obvious conflict of interest as well as potential disclosure requirements that would need to be in place if there were such incentives taking place. As we shift to looking at information security, the cybersecurity and privacy certainly have been an ongoing theme for a number of years. The SEC has had several cybersecurity sweeps. The most recent sweep covering RIAs that have gone through mergers and acquisitions, as well as RIAs that have multiple branches. The goal here is to ensure that as firms go through these types of events or have these types of office locations, that their policies and procedures cover these type of arrangements. Additionally, when we look at privacy and cybersecurity, it is of the utmost importance to protect clients' personal identifiable information. How you're distributing client information, are you sending emails with this type of information? What are you doing to protect that information? Are you using encrypted software? Are you using password protected documents? Are you sending these documents to a vault where the client can log into an encrypted website and access the document or documents? The SEC also looks at how firms are managing their third-party vendor risk management. Certainly when it comes to vendors that have access to your client personal identifiable information, the expectation is you're going to spend more time and perform more due diligence in terms of being comfortable with that vendor's policies and procedures in terms of deciding to first engage in using that vendor, and at least on an annual basis to continue utilizing that vendor. A really good example of this last year was when Redtail went through a breach. Now, that breach didn't affect all of their clients. To my knowledge, none of our clients that utilize Redtail had any client information that was breached. That being said, in discussions with clients who use Redtail, certainly as a customer of Redtail, you would want to be comfortable with what happened, how they addressed it, and what potential policies or procedures they put into place to hopefully prevent it from happening in the future. So when talking to clients that utilize Redtail, we recommended that they certainly reach out to Redtail and do some additional due diligence and determine if they are in fact comfortable continuing to use Redtail as a vendor. And in most cases, our client base continued to use Redtail, but I know for myself, I had one client that unfortunately wasn't comfortable and decided to move on. What this evidence, though, is a good process of monitoring your vendors and making intelligent or thoughtful decisions as to the future or continued use of a vendor who's gone through such a situation. Now, generally speaking, you don't have to be SOX experts when it comes to this type of due diligence in terms of your vendor risk management or oversight. Certainly, you want to collect what their cybersecurity policy looks like, what their BCP looks like, as well as what their privacy policy looks like, just to ensure that, especially on the privacy side, that there's no differences in terms of what you state as a firm as your privacy policy as compared to what your vendor is communicating. That's a good segue into the Reg SP and Reg SID. When we look at Reg SP, we're talking about your initial delivery of your privacy policy statement, as well as your ongoing responsibility to annually distribute that privacy policy. When we look at the Reg SID, here we're talking about your identity theft red flags. And when it comes to these red flags, what things do you have in place internally to hopefully identify things like if a client's email is hacked, as a good example? The SEC also, within this area of their priorities, discussed or talked about controls firms have around online access and mobile application access to client account information. In other words, do your advisors use tablets? Are they accessing this information through their smartphones? Are you utilizing two-factor authentication? We as a firm, through our Advisor Cloud platform, have created a compliance activity task, which is titled Personal Device Usage Review. So certainly you want to be performing at least an annual review of what devices your advisors are utilizing to access client information, ensure that those are protected in the event they, unfortunately, if they lose them or they're stolen, that the information contained on those devices won't be able to be obtained by another person. And then lastly, the SEC hits on the proper disposal or safeguards around hardware that's no longer being used. How do you sunset devices, whether it's laptops, desktops, etc.? It's important to have some form of policy in place, whether that's a drive wiper or something of that nature, so that the device or computer is completely wiped of any information that may have been maintained through that particular hardware. Next, we take a look at financial technology and innovation. Certainly, the SEC has made it clear that there are challenges ahead that they'll have to address, in particular in fintech and innovation, without question. They have focused on, as I mentioned previously, digital assets as well as electronic investment advice, and they continue to do so this year. In looking at the digital asset side of things, one of the things the SEC launched was their strategic hub for innovation and financial technology, FinHub. And this is an area where certainly users can go and learn a lot about how the SEC interprets digital assets. It can assist in your review of determining whether a digital asset is required to be registered, so that you certainly stay within the compliance rules and regulations when working in this particular area. When it comes to electronic advice, again, last year was the first time we saw some enforcement against the robo-advisors, or some, not all of the advisors, but some of the robo-advisors. Here, the SEC is focusing on twofold. One, the actual advice producer, in terms of whether they are required or not required to be registered, what their cybersecurity and policies and procedures are, how they market their services, as well as their adherence to a fiduciary duty. In addition, they're looking at RIAs who utilize electronic advice, like the platforms that are available through Fidelity and Schwab, for example, and making sure that you have adequate disclosures with respect to the services that are being provided, and well as how the fees are being processed with respect to those client engagements. There are a number of additional focus areas that the SEC communicated in this year's priorities. You can't go enough without saying that your compliance program is essential in terms of your examination process. That will include your compliance manual, your business continuity plan, your cybersecurity policy, as well as your code of ethics. In this priority, the SEC mentions best execution, oversight of registered representatives, prohibited transactions, disclosures of conflicts, which again is an ongoing theme throughout, due diligence for third-party or independent managers, fees and compensation, fiduciary advice, and just general due diligence on investments being utilized with clients. It's important to note that each year firms should be going through all of their compliance program documents, ensuring that the policies and procedures reflect the actual compliance that's taking place at the firm. Also to ensure that what you state you're doing in your compliance program document is actually taking place. And that's certainly accomplished via your risk assessments, completing craft modules, as well as completing any compliance activities. The SEC also points out that their expectation is that firms' policies and procedures need to be reasonably designed, implemented, and maintained. The SEC also went out to focus on private fund advisors, looking at things like side-by-side management, ensuring that controls are in place to prevent the misuse of material non-public information, and to ensure that conflicts of interest, such as inadequately disclosed fees and expenses, have been addressed. And lastly the use of any advisory affiliates to provide services to clients. So they're definitely looking under the hood when it comes to situations where an RIA is associated with private funds, as well as being the advisor to the private fund. As many of you know, if you're a new SEC registrant, you may have already gone through one of the priorities of the SEC, which is to examine new registrants. They are also focusing on examining firms that have either never been examined or it's been a while since their last examination. So then I just wanted to hit on a couple of other items in terms of things that certainly you want to be cognizant of here in 2020 with respect to the SEC, at least for now. The first item has to do with the Form CRS, the Client Relationship Summary Form, otherwise known as the ADV Part 3. It's important to note that this form cannot be filed until May 1st at the earliest. It must be filed no later than June 30th. We here at AdvisorAssist will be helping draft the initial Form CRS for clients, as well as filing that once it's been accepted and approved by you as our clients. We will then provide you with some language in terms of issuing or distributing the Form CRS to your clients. 2020, obviously it'll be clunky in that here in the first quarter, we're wrapping up annual amendments, which will then be distributed to clients by the end of April, just to, again, distribute the new Form CRS a few months later. In future years, this won't be as clunky. We'll be able to combine your Form CRS delivery requirement with your ADV2 annual amendment, so it'll be much more seamless. Two other things to point out have to do with rule proposals that were initiated last year by the SEC. Those involve the advertising rule as well as the cash solicitation rule. In terms of the status of both of these, they have passed the public comment period, so we are sitting and waiting for the final decision as to what these proposed rules are on a moving forward basis. One of the most interesting part of the advertising rule proposal was the permission or allowing advisors to use testimonials and endorsements. This has been a prohibited activity forever, so it's certainly interesting that the SEC has taken an about face with this particular topic. The SEC has said that they're calling this the modernization of the advertising rule, which kind of makes sense considering that the amount of social media that's out there and what can or can't be done. Certainly, if this proposal continues to go through, firms will have to create and maintain policies and procedures around the use of endorsements and testimonials. We certainly will be working with clients if this rule goes into effect on how, if they want to utilize these, how to best do it and remain compliant in terms of meeting their regulatory responsibilities as it applies to the use of testimonials and endorsements. When it comes to the cash solicitation rule, there wasn't really anything significant to identify in terms of the changes with respect to this rule. It certainly makes it easier for firms that want to utilize in-house solicitors for the firm. What I would say here is, as you move through 2020, if this is something new that the firm would like to engage in, reach out to your consultant. We certainly will work within the current rules and regulations in terms of you offering or utilizing a solicitor or solicitors. And then if in fact this proposal goes through and there are any changes, we'll work with you to implement how those changes might impact any current solicitor relationships you may have. So that's going to cover the content for today. At this time, I'm going to shift over to questions that have been submitted throughout the course of the presentation. We have a good chunk, so thank you so much in advance for everybody's participation with respect to sending over these questions. And we can kick these off and get started. First question today has to do with the SEC's choice or decision to focus in terms of retail investors on teachers. As I mentioned earlier, the retail focus has to do with senior investors, investors nearing retirement, teachers, as well as military personnel. My only conclusion in terms of why the SEC has put a focus on this area is more than likely due to some set of data points, such as they may have seen an uptick in complaints where teachers are concerned and situations that they may have gone through in the previous year. It could just be something that they identified throughout the course of their examinations in the last year. So as a result, they feel it's important to note that when they're conducting their exams for this year, this will be a focus area. They, however, did not come out and provide any specific language as to why teachers, for example, are now a particular demographic that they're focusing on. Next question has to do with the Form CRS and basically what is it? So the client relationship summary form, we were informed by the SEC last June that this will be a requirement for 2020. The form itself is a very prescribed document. It has to be 2 pages. cannot be any longer, and it will include very specific information. When I look at, from my perspective, why the SEC implemented the Form CRS, it's a correcting an error that they didn't anticipate previously. When Dodd-Frank was approved and the ADV2 structure changed to the plain English version, I believe the SEC felt that prospects and clients would be able to take these plain English ADV2As, put them side by side, and do an analysis and be able to pretty easily decide which advisor or advisors they want to work with as a result of that review. Unfortunately, when you look at ADV2As, they really have taken on a life of their own over the years, and one firm's ADV could be 10 pages, ADV2A, another's could be 50 pages. It's really, all over the place. So in correcting that situation, the two-pager for RIAs will literally allow an investor or prospect, retail investor, to put 5 different, for example, RIAs, Form CRSs in front of them, and really be able to do an analysis of those 2 pages and hopefully be able to identify which advisor or advisors they want to move forward with in their discussion. That's my perspective. In terms of the filing requirements, as I mentioned earlier, the earliest we can file your Form CRS will be on May 1st, and it has to be filed no later than the end of June, as well as delivered to clients by the end of June. So we will be working with our clients to create that Form CRS. Once it's finalized, again, we'll file it just like we do your other ADV documents and provide you with some language if you'd like to use to distribute this document to your clients. In terms of the next question, the definition of a private fund manager, here we're really looking at RIAs that are also advisor to private funds. Certainly there's an inherent conflict of interest in that scenario. There are significant disclosures that need to take place in terms of why this is a focus area of the SEC. But to answer the question specifically, we're looking at advisors, RAs, who are advisors to private funds. Next question has to do with cybersecurity and how it applies to firms of different sizes, right? As you can imagine, in terms of your size, if you're in New York and you have 25 million in assets, you have to register as an SEC firm. And then there are firms that are SEC registered with billions of dollars in assets under management. Depending on the complexity of the firm, the risks of the firm, how you communicate with clients, there are a number of factors that are going to help determine what your cybersecurity tech stack is going to look like. In some cases, it may be very basic in terms of what you're doing, in terms of protecting client information and what your cybersecurity policy actually is. And then depending again on your size and scope of your firm and risk of your firm, it could become very complex. Because of the general nature of the question, my recommendation in these scenarios is pick up the phone, get on a call with your consultant. Certainly you can step through with your consultant what makes sense in terms of what your particular policy should look like. Do you need a third-party tech vendor to help out? What types of technologies can you utilize to implement what your policies and procedures say? So definitely, if you want to do a review of that, reach out to your compliance consultant and have that discussion. But as you can imagine, there's no one-size-fits-all in terms of cybersecurity and technology. Each scenario is going to dictate what tools or technology should be in place with respect to your cybersecurity program. Earlier, I talked about personal devices, so there was a question about the compliance activity in terms of personal devices and where it's located. So within Advisor Cloud, under your year-end compliance and then compliance activities, Once you go to that page within Advisor Cloud, you'll see it as one of your 2020 compliance tasks. If you have any questions as you go through that particular task, certainly reach out to your consultant or to support at AdvisorAssist, and we will help you in addressing that particular task. It's certainly important, on an annual basis or a regular basis to make sure you know how your advisors, how your people are accessing client data. Obviously, the more information you know, the better protected you will be against devices that aren't protected, computers that aren't encrypted, things of that nature. Next question has to do with what are some of the common issues identified through the new registrant exam? It's a great question. There's no real pattern here, but what we tend to see is, as a result of the challenge of both launching your firm, transitioning your firm, is that sometimes things aren't being done that you say you're supposed to be doing within your compliance program. It's a constant battle and challenge. And it's important to note that these new registrant exams, the goal is to really understand the firm, understand your organizational structure, understand if you have any affiliations, understand how you manage portfolios, how you obtain clients, confirm that you have adequate policies and procedures in place. You didn't just go buy a policy off the internet and slap your name on it. That you have good client agreements. You have all these things in place. To the extent a deficiency is identified, the goal of this exam is to give you this initial notice to correct that particular item. So after you kind of go through the process of the examination, if the SEC were to identify an issue, a finding, a deficiency, you're going to have 30 days basically to respond to the SEC on how you resolve that particular item. So again, rest assured that these new exams are designed to be big picture, macro views of firms and their business practices. Okay. Next question has to do with audits as well, examinations. And the question is, how does one prepare for an examination? The best advice I can provide here, guidance, is that you are doing the day-to-day, week-to-week, month-to-month, ongoing compliance requirements that are necessary within your policies and procedures. To the extent you're doing your compliance, that's a big chunk of what is going to be asked during the course of your exam. Again, the initial exams that won't necessarily get into the weeds of all of the day-to-day, but certainly a more traditional exam will look at those things. And what are those things? Your email review, things of that nature, suitability reviews, just to name a few. So there's the best way, I should say, to prepare for the audit is to, again, be doing the day-to-day items. We provide you with compliance activities to help support the completion of those ongoing compliance responsibilities. Another good tool is our books and records matrix. That is, again, a task within your compliance activities. The books and records matrix is going to help cover you with things that are not just included in the management of client accounts per se, but it's also going to make sure you've got all of your financial documents located so that, again, if you go through one of these audits, you know exactly where to identify or pull that information from. It's a good tool to have in your back pocket as you go through these exams, is that books and records matrix. Depending on when you were approved as an SEC registrant and you are going through your initial examination, certainly to the extent you can be completed with your prior year's risk assessments, your annual CCO report, if applicable, depending on when you were approved. Having those items all buttoned up prior to the SEC coming in will also prove to be beneficial should those documents be requested. So I guess the moral of the story there is stay current with your compliance activities, risk assessments, And generally speaking, you should be in phenomenal shape for that initial exam, or any exam for that matter. The next question has to do with basically what is the SEC's power or role or oversight of registered representatives' activities. So if we take a step back, obviously the SEC is responsible for not just RAs, but broker-dealers as well. Generally speaking, there is a line between which side of the SEC is performing a particular examination. In other words, the SEC RIA examination team is going to examine RIAs. They won't necessarily delve into the broker-dealer side of the examination process unless they feel it's appropriate. So in other words, we have a client recently who basically they have one advisor who's also a registered rep, and for whatever reason, the SEC has decided to pull a commission run for that registered rep. They have the power to do it, they're entitled to do it. It's not something we see all the time, but it could be a requested document as part of your examination. So in that regard, you would certainly need to produce it for your examiner if it is requested. But again, generally speaking, there will be a separation between those activities. The next question had to do with share classes and moving from, say, a higher fee share class to a lower fee share class. So I think it's good to repeat or again, comment on the fact that the SEC, as part of an initial exam or a full exam, will be pulling your holdings reports. An easy thing for them to look at in your holdings reports are going to be share classes. A shares, B shares, C shares, whatever the share class might be, if it's something other than an I share. To that extent, you want to make sure you've documented why you are holding a particular share class that is higher as far as its internals and expenses are concerned versus the lower share class at that fund company. And again, I mentioned earlier, there's a number of reasons to support why you might be holding that particular share class, but it doesn't you no good if it's not documented. It's the traditional saying, if you don't document it, it never happens. So what options do you have in the scenario where you have an A share and you're looking to get into a lower share class? Well, certainly depending on, again, the taxes and other ramifications, you may be able to just sell it, right? That's a pretty straightforward option. But you also may be able to convert the share class. A lot of mutual fund companies allow for clients to convert, for example, their A shares to an I share. So I certainly would recommend contacting your custodian, trading desk, talking to them about what options you may have with a particular fund and whether it's eligible to be converted to a lower share class, expense share class. Next question has to do with, and this is always a great question, what are the attitudes and personalities of examiners? It's interesting in terms of it's no different than Forrest Gump, and it's like a box of chocolates. You never know what you're going to get. It's the same when it comes to examiners. I fortunately have been in the business long enough to have worked with tons of different examiners, FINRA examiners, DOL examiners, SEC examiners, state examiners. And literally, you never know what you're going to get. Generally speaking, there's a few different types of examiners you're going to get. You may get somebody who's maybe a veteran who literally is just happy to be doing their job. They come in, do their job, and move on. Alternatively, you may get somebody who's out to make a name for themselves. So they're going to dig, trying to find something that the firm isn't doing what they feel they should be doing, identify deficiencies, etc. Those are less frequent from my experience, but you may, unfortunately, end up with somebody like that. For the most part, examiners are just like anybody else. They have lives, they have families, it's their job. So to that end, I think what's most important is how we treat examiners in terms of how we work with them, right? Everybody's seen Wolf of Wall Street and, you know, changing the temperature settings in the office, making it uncomfortable for examiners to be there. To me, that's a load of garbage, right? And I'm sure you all agree. The goal of an examination, I always subscribe to, is to make my firm better. If you find something, great, we're going to fix it. Or we're going to look and see what happened and why that happened, and hopefully be able to address it in terms of mitigating it so it doesn't happen again. Treat it as a learning opportunity. Try to make the examiners as comfortable as possible. Not so much that they want to live there, obviously, but comfortable enough to get their job done and get out and move on to the next examination. Next question has to do with looking at what an exam cycle may look like. So first and foremost, with the new registrant cycle, really you're looking at the first couple of years since you get approved for SEC registration, that you can expect to have that initial exam take place. It's otherwise known as a limited scope exam. Generally, it's going to be 13 items, ranging from your org chart, your client agreements, holdings reports, client lists, current employees, former employees, advertising, advertisements during the exam period, ADV 2Bs, the basis for your registration. That basically covers the vast majority of what's asked of you. You may see the SEC come in a little bit later. We have had some clients that have been in existence for 3 years, 4 years that haven't gone through that process. They shouldn't expect, more than likely they're going to have an exam sooner rather than later, considering this priority that the SEC has put in place, as well as the second side of that priority, which is visiting never before seen or not recently seen firms. Assuming you've gone through that initial examination, that new registrant examination, there's no prescribed schedule when it comes to when your next exam is going to be. In the FINRA world, they previously or historically, you were actually put on a cycle as a broker-dealer. You were either on an every year cycle, every couple of years, every 3 years, whatever the case may be, based on your firm and a number of other factors. In the RIA world, there is no similar schedule. So what the SEC does is they take a more risk-based approach to when they're going to examine RIAs. Obviously, there are tons of RIAs out there. The SEC has said as much that there's no way for them to examine everybody. Certainly the RIA space continues to grow, and new registrants and new firms are starting up all the time. So what does that mean to you? It all depends on what you're doing as a firm in terms of the advisory services you're offering, affiliations you may have, products you're using. In other words, the more risky the perception is of your firm, the more likely you're going to be visited on a more frequent basis. And that's neither a good, bad, or indifferent thing. It's just what it is. To the extent your firm is less complex, you're just using ETFs, you don't even use mutual funds, you're just providing investment management services, the chances are you're going to be visited less frequently. That's the best way to look at it in terms of how often you may see a regulator want to examine your office. Now, that all being said, if you go through an examination and the SEC uncovers deficiencies, and let's just say some of these deficiencies are significant, that's going to expedite them coming back in. Their goal is certainly to make sure that you've corrected any of those deficiencies, you've resolved those deficiencies, and that you have a stronger compliance program in place the next time they come in. Too many times you see, and you can read about this in SEC files or filings and communications, that repeat deficiencies are an issue. It shows a failure of firms to recognize the importance of compliance. It circles all the way back to what we kicked today's conversation off with, is what is your compliance culture? What's the tone from the top, and how, how are firms empowering CCOs to administer their compliance programs? All of that will dictate how frequently the ACC is going to come in and examine your firm. To the extent you have no deficiencies, I don't care how risky you are, you can pretty sure, or rest assured, they're not going to be in there on a regular, frequent basis. That being said, the more deficiencies you have on an ongoing basis, the more frequently they're going to, more than likely, want to examine your firm. Okay, looks like we are out of questions today. Certainly, if you have any additional questions, by all means, feel free to reach out to your consultant or to someone here at AdvisorAssist to assist you and follow up with you. Again, I want to thank you for participating in today's webinar. Please keep an eye out as we continue to conduct more of these throughout the course of 2020. And again, thank you so much for taking time out of your days. I hope you all have a wonderful rest of your day.